October 2025. China exports 660 metric tons of silver in a single month, 21.2 million ounces flooding into global markets. That's double their 5-year monthly average. An emergency liquidation from national stockpiles at a scale never seen before. Every economics textbook says the same thing. When supply surges, prices fall. Silver didn't fall. It exploded to $67.10 per ounce by December, a 127% gain in under 12 months. Here's what that tells you. The real threat isn't the headline dump. It's the physical delivery stress underneath the paper market. And that stress is now entering stage 3 of a 4-stage breakdown pattern that has destroyed paper commodity systems throughout history. This isn't about whether silver crashes or moons. This is about recognizing when a paper pricing system loses its ability to reflect physical reality and what happens to the markets built on that fiction. By the end of this video, you'll understand why China's 660-ton export revealed physical scarcity, not oversupply. Why COMEX and LBMA inventory drawdowns signal stage 2 stress already in progress. How lease rate spikes and backwardation patterns expose delivery constraints the paper market can't solve. What the 4-stage paper-to-physical breakdown looks like and where we are today. Why your inflation hedges, industrial inputs, and real asset positioning are all affected when trust breaks. The specific indicators to watch as this system either stabilizes or enters terminal phase. What history shows happens when paper markets decouple from physical delivery capacity. Let me show you the pattern that repeats every time a commodity market transitions from paper-driven pricing to physical scarcity-driven pricing. Stage 1, inventory drawdowns. Visible stockpiles decline steadily as industrial demand outpaces supply. Market participants notice but rationalize it as temporary imbalance. Prices rise moderately, reflecting mild tightness but not systemic stress. The paper market still functions normally. Futures contracts roll forward, delivery obligations are met, premiums remain modest. Stage 2, lease rate spikes and backwardation signals. Lease rates, the cost to borrow physical metal for short-term delivery, begin spiking as market makers struggle to source metal. Backwardation emerges, near-term contracts. Trade at premiums to longer-dated contracts, indicating immediate scarcity. This is the canary in the coal mine moment. The paper market is still operational, but stress is visible to anyone watching the right indicators. Stage 3, delivery stress and widening spreads. Physical delivery delays extend from days to weeks. Premiums for immediate delivery explode as buyers pay massive markups to secure metal. Futures exchanges implement emergency measures, margin increases, position limits, cash settlement provisions. The paper market begins losing credibility as participants question whether contracts can actually be settled with physical metal. Stage 4, forced repricing. Paper loses control. The paper market collapses or becomes irrelevant. Physical transactions occur at prices disconnected from futures quotes. Buyers refuse paper contracts, demanding physical delivery regardless of cost. Industrial users hoard inventory, anticipating supply chain breakdown. The system reprices violently as paper claims are revealed to exceed available physical supply. Where are we today? Stage 2, approaching stage 3. The signals are visible, they're still deniable by mainstream analysts, but the trajectory is clear. In 1979-1980, the Hunt brothers attempted to corner the physical silver market, accumulating over 100 million ounces through futures contracts and direct purchases. Their strategy wasn't complex. Buy futures, demand physical delivery, accumulate metal, repeat. As delivery demands accelerated through late 1979, something unexpected happened. The paper market couldn't source enough physical metal to satisfy contracts. Lease rates, normally 1 to 3% annualized, spiked to 25%, then 40%, eventually exceeding 50% as desperate short sellers scrambled to borrow metal for delivery. Warehouse stocks at COMEX plummeted. By January 1980, registered inventory available for delivery had fallen below 40 million ounces, while open interest exceeded 120 million ounces. The mathematical impossibility became obvious. More claims existed than available metal. COMEX responded with emergency rule changes. On January 21, 1980, they implemented liquidation-only trading for silver futures, prohibiting new long positions. This wasn't market regulation. This was acknowledgement that the exchange couldn't fulfill its fundamental purpose, delivering physical commodities against paper contracts. Silver hit $50 per ounce in January 1980, not because of manipulation, but because the paper market lost credibility. When the rule changes forced liquidation, prices collapsed. But the lesson remained, when delivery stress exceeds system capacity, the pricing mechanism breaks, regardless of underlying supply. The Hunt brothers didn't create a shortage. They exposed that the paper market had always been trading claims to more metal than physically existed in deliverable form. The system worked only as long as most participants accepted cash settlement instead of demanding physical delivery. In 1961, 8 central banks formed the London Gold Pool to suppress gold prices and defend the Bretton Woods fixed exchange rate system. The mechanism was straightforward. When gold prices rose above $35.20 per ounce, the pool sold physical reserves to push prices back down. For 6 years, it worked. The pool sold over 2,800 tons of gold between 1961 and 1967, maintaining price stability and defending dollar credibility. Markets believed the system was sustainable because central banks possessed vast reserves and political will to defend the peg. Then physical demand accelerated. French President Charles de Gaulle began demanding gold for dollars, converting billions. Private buyers in Europe and Asia increased purchases as dollar credibility eroded. By 1967, the pool was selling 100-plus tons monthly just to maintain the fiction of $35 gold. The breaking point came in March 1968. In a single 2-week period, the pool bled over 1,000 tons trying to defend the price. Daily sales exceeded 100 tons on multiple occasions. The rate of depletion made continuation mathematically impossible. They would exhaust reserves within months at that pace. On March 17, 1968, the London gold market closed for 2 weeks. When it reopened, the pool was abandoned. Gold was allowed to trade freely in private markets, while official transactions remained at $35. This dual pricing system lasted 3 years before a total collapse in 1971, when Nixon closed the gold window entirely. The system didn't fail because they ran out of gold. It failed because the rate of physical demand exceeded sustainable supply. When delivery obligations require liquidating reserves faster than politically acceptable, the system reprices violently. Gold went from $35 in 1968 to $850 by 1980, a 24x increase in 12 years. Russia, the dominant palladium supplier, delayed exports in 2000, citing administrative issues. The real reason didn't matter. What mattered was that physical metal stopped flowing into Western markets when automotive manufacturers needed it for catalytic converter production. Lease rates exploded past 100% annualized as short sellers scrambled to borrow metal for delivery. Physical delivery delays stretched to months. Automakers faced production shutdowns because they couldn't source 2-gram quantities of palladium per vehicle, a 10-component threatening billion-dollar production lines. Palladium repriced from $300 Oz to 1/100 Oz in 18 months. Not because the world ran out permanently, but because the paper market couldn't bridge the timing gap between supply and demand. When industrial users can't guarantee component availability, they panic buy regardless of price. The pattern repeats. When paper markets lose the ability to deliver physical commodities at the scale and speed demanded, pricing mechanisms break. It doesn't matter if enough metal exists somewhere. What matters is whether the system can deliver when and where needed. COMEX registered silver, metal available for immediate delivery against futures contracts, has declined from over 150 million ounces in 2021 to approximately 43 million ounces by late 2025. That's a 71% drawdown in 4 years, accelerating in the second half of 2025 as industrial demand surged. To understand why this matters, you need to understand how COMEX inventory classification works. Total COMEX silver inventory divides into 2 categories, eligible and registered. Eligible inventory sits in COMEX-approved warehouses, but is not available for delivery. Owners have withdrawn it from the deliverable pool. Registered inventory can be delivered against futures contracts. The distinction is critical. When industrial users or investors take delivery and convert metal from registered to eligible status, they're effectively removing supply from the market while keeping it in COMEX warehouses. The metal exists physically, but it's no longer available to satisfy contracts. Here's the key detail. Daily trading volume on COMEX silver futures often exceeds 100,000 contracts during periods of elevated activity. Each contract represents 5,000 ounces. That's 500 million ounces of notional trading volume, nearly 12 times the registered inventory available for delivery. This isn't fraud or manipulation. Futures markets have always functioned this way. Most contracts settle financially, with traders closing positions before expiration rather than taking physical delivery. The system works beautifully until a significant percentage of longs demand physical settlement. If just 10% of open interest demanded delivery during a concentrated period, COMEX couldn't fulfill the obligations with available registered inventory. The exchange would face a choice. Find more metal by converting eligible to registered, which requires owner consent, implement cash settlement provisions, or restrict trading like they did in 1980. When registered inventory falls below 30 million ounces, the system enters dangerous territory. At that level, a single large industrial buyer or investment fund demanding delivery could trigger exchange intervention. Shanghai Exchange Inventory Drawdown. Shanghai Futures. Exchange silver inventories collapsed from approximately 3,600 tons in 2021 to under 900 tons by December 2025, a 75% decline in visible Chinese stockpiles over 4 years. China simultaneously produces around 3,300 tons annually while consuming approximately 19,000 tons for industrial use. That's a 15,700 ton annual deficit requiring imports or stockpile drawdowns to bridge the gap. The Shanghai inventory collapse reveals they've been burning reserves while trying to source imports. When Chinese domestic inventories evaporate, they face a choice: restrict exports to protect domestic industry or raid strategic reserves to prevent global market breakdown. The 660-ton October dump was option 2, emergency liquidation to keep London's market functional. Lease rate spikes. Silver lease rates, the annualized cost to borrow physical metal, spiked to 15-20% in October 2025 during the London squeeze. Normal rates range from 0.5 to 2%. When borrowing costs exceed 10%, it signals acute physical scarcity. Market makers cannot easily source metal to meet short-term obligations. Backwardation in silver futures. In November to December 2025, silver futures exhibited persistent backwardation, near-term contracts, trading at premiums to longer-dated contracts. This signals the market values immediate physical possession over future delivery, indicating doubt that future supply will be available at quoted prices. Physical delivery delays. Reports from London and Indian markets in October-November 2025 indicated delivery delays stretching to 2 out of 3 weeks, with buyers paying 10 to 15% premiums for immediate settlement. Large transactions exceeding 1,000 ounces faced particular difficulty. This is stage 2 approaching stage 3, ETF outflows versus physical demand. Silver ETFs like SLV experienced net outflows throughout Q4 2025 despite all-time high prices. Investors are rotating from paper exposure to physical possession. When ETF redemption rates exceed operational capacity, the structure becomes stressed. China's January 2026 export restrictions. On January 1, 2026, China implemented export licensing, requiring 80-ton annual minimum production and state approval. This consolidates exports into state-owned enterprises, potentially reducing Chinese exports by 50-70% versus 2025 levels. The restriction doesn't create the shortage. It reveals the shortage already exists. When paper markets lose credibility, industrial users hoard inventory. This isn't speculation, it's risk management. A solar manufacturer operating on 30-day inventory buffers faces existential risk if silver supply chains break down. Production lines shut down. Customer contracts can't be fulfilled. Revenue evaporates while fixed costs continue. So what do? They try to secure 90 to 180 days of inventory instead, tripling their immediate demand. They sign long-term supply contracts with penalty clauses if suppliers fail to deliver. They pay premiums for guaranteed allocation. Every rational actor makes the same decision simultaneously. This behavior amplifies the shortage in a self-reinforcing cycle. When 1,000 solar manufacturers globally each try to triple their silver inventory from 30 to 90 days, they collectively add months of normal consumption to immediate demand. The market can't possibly satisfy this surge. Mining output increases 1 to 2% annually, not the 200% jump required to meet panic buying. The result cascades through supply chains. Solar panel production faces delays. EV manufacturers struggle to source components requiring silver conductors. Electronics makers compete for limited supply. Companies with weaker balance sheets or inferior supplier relationships get squeezed out entirely. Prices rise throughout the chain. A solar panel manufacturer facing 30% higher silver costs does not absorb the increase. They pass it to customers through price increases. Residential and commercial solar installations become more expensive. EV prices rise. Consumer electronics cost more. The silver shortage becomes an inflation accelerant across multiple sectors simultaneously. For the middle class, this shows up as higher costs for the exact products marketed as solutions to other problems. Want to install solar panels to reduce electricity costs? The panels cost more due to silver shortages. Want to buy an EV to save on fuel? The vehicle costs more due to silver-dependent components. The transition to green technology accelerates silver consumption while supply chains break under the strain. This is how commodity shortages translate into purchasing power erosion for ordinary people, not through direct silver ownership, but through the industrial products that depend on silver becoming structurally more expensive. Silver is supposed to be an inflation hedge, a store of value when currency depreciates and purchasing power erodes. For centuries, physical silver and gold served this function. And when governments debased coinage or printed paper money excessively, those holding precious metals preserved wealth while paper currency holders suffered. But here's the modern paradox. When physical delivery stress breaks the paper market, your ability to access that hedge depends entirely on how you hold the exposure. If you own paper silver through futures contracts, you're exposed to exchange intervention. When COMEX implements cash settlement provisions or position limits, your silver exposure becomes a cash payment at whatever price the exchange determines. You don't control the outcome. The exchange can force liquidation at disadvantageous prices during the exact moment of maximum market stress. If you own silver ETFs like SLV, you hold shares backed by vault allocations, in theory. But ETF structures aren't designed for mass physical redemption. The creation-destruction mechanism works efficiently when investors trade shares, but breaks down if large numbers of shareholders demand physical metal instead of cash redemption. The prospectus contains language limiting physical delivery to authorized participants making minimum redemption sizes, typically 50,000 ounces or more. If you own mining stocks, you have exposure to silver price movements but no claim to physical metal. Your return depends on the company's production costs, reserve quality, operational efficiency, and management decisions. During supply shocks, mining stocks can dramatically outperform or underperform physical metal, depending on factors unrelated to the silver market itself. If you own physical silver, coins, bars, allocated storage with title in your name, you benefit from repricing and maintain control of the asset. But you face different constraints: storage costs, insurance requirements, liquidity challenges when selling large quantities, and potential difficulty converting physical metal back to currency during market dislocations. The paradox becomes most acute during the transition from stage 2 to stage 3. As delivery stress accelerates, the spread between paper and physical pricing widens. Paper contracts might quote $50 AUS while physical buyers pay 60 plus for immediate delivery. This divergence reveals that paper claims have lost credibility. The market no longer believes all contracts can be satisfied with physical metal. Understanding this dynamic matters because it changes the definition of holding silver. In stable markets, paper and physical exposure converge. In stressed markets, they diverge dramatically. Your inflation hedge only functions if you hold the right form of exposure when the system reprices. When trust in paper claims erodes, capital rotates into tangible assets, not just silver, but gold, farmland, productive infrastructure, commodities with physical utility. This rotation is not driven by speculation, but by recognition that paper promises may exceed the system's ability to deliver. This creates a self-reinforcing cycle. As investors flee paper exposure, they amplify the delivery stress that caused the initial breakdown. The loss of confidence triggers behaviors that justify the loss of confidence. Prices rise not because of new scarcity, but because market participants revalue certainty of physical possession versus uncertainty of paper claims. History shows this ends in forced repricing. Either prices rise high enough to destroy demand, forcing industrial conservation and material substitution, or the system physically exhausts available supply and trading halts until new equilibrium emerges. There is no third path where paper markets continue functioning normally while physical delivery stress accelerates. Here are 5 signals to watch in 2026. Signal number 1, COMEX registered inventory falling below 30 million ounces. If this occurs, the paper market has less than 30 days of deliverable supply against typical trading volumes. Signal number 2, lease rates sustaining above 20% for more than 2 weeks. This indicates chronic physical scarcity, not temporary tightness. Signal number 3, physical delivery premiums exceeding 20% for large transactions. This signals stage 3 entry, paper pricing losing relevance. Signal number 4, exchange implementation of cash settlement provisions or delivery restrictions. This is the breaking glass moment where exchanges admit they cannot deliver physical metal. Signal number 5, major industrial users announcing production delays due to silver supply constraints. This confirms the shortage has escaped financial markets and entered the real economy. Next episode, how the global debt crisis is colliding with commodity scarcity, and why the 318 trillion debt bubble makes stage 4 inevitable. The pattern is documented. The sequence is clear. The only question is whether you see the repricing before the market forces it on everyone at once. This isn't about predicting the future. This is about recognizing when a system is operating outside its sustainable parameters and understanding what historically happens next.